Joining us to take some questions. Dean, good to have you with us here. Thanks very much. What next for for equity markets, Dean? We've had a pretty nice move here in India, a powerful 8-day move, and in the US as well. Although in the US, it's been pretty clear that we are bumping into resistances on the S&P, especially around the 4,100, 4,120 odd levels.
Yeah, so today was all about the CPI, which came in cooler than expected, but the print was not convincingly low enough to really boost the market. While food and energy prices came down, inflation related to housing continues to be stubborn by edging up 50 basis points month over month. But the slope is coming down, so we will likely see this portion of the CPI going negative fairly soon. And coincidentally, the Fed released the March FOMC meeting minutes, and they do expect the U.S. economy to head into recession by the end of this year. This is really no surprise given the fallout of the banking sector and the tight liquidity situation that we are in now. But the overall market hung in there quite well today, with both S&P and NASDAQ keeping well above key moving averages. And in terms of the resistance levels on the S&P, we're looking at February high of about 4192. NASDAQ as well, we're looking at February high of 12,262. So those are the levels that we're keeping an eye on. But until then, I think we have to wait and see what happens with the data that as we go forward, in terms of the future releases. Breadth-wise in the market, we're making some improvements. We're currently at 45% of New York Stock Exchange trading above the 150-day moving average, whereas this was only 30% back in March. So making some progress, but yeah, there are some uncertainties going forward for sure.
Okay, thanks a lot for joining in though on the show, Dean. Let's quickly run through some of the big numbers to watch. So TCS as a stock is something that everyone's going to be tracking today, given that the numbers have been weak and the commentary from the management has been quite cautious. How do you see the charts now? Do you think that there is more downside for technology companies in the Indian market?
I think they're kind of range bound at the moment. Both TCS and Infosys currently trading in a flat base. They do have some work to do. I think TCS, is doing slightly better because they are running up against 200-day moving average. But stocks like Infosys trading at the bottom end of the range in terms of the flat base. So definitely they have some work to do. What I'm wondering about though is, in terms of the future outlook. They do, especially Infosys does a lot of work outside of India, particularly in the U.S. And if companies are going to be heading into sort of a slowdown, I'm wondering, if that's going to create a tailwind or headwinds. But we rely on the charts, and for now, I think they're fine. They're trading in a base, but let's see if they can get over the 200-day moving average first.
All right, Dean, final question before we let you go. Then in terms of preference, I recall last time we chatted, you were talking about the Korean market as well as the Hong Kong market. Where does India feature in that list, if you could tell us? And also, what are the levels you're looking at on the Nifty from here on?
Yeah, so basically we, re-rated Indian market at the end of March, actually the day I spoke here last. We had a follow-through day. And the market had a nice move. Basically, it's running up against a bit of a resistance at the 100-day moving average on the Sensex. So we have to, hopefully get over this level. That would be great if we can do that. But we may see some resistance here and sort of, trade between 100-day moving average and 200-day moving average. But if we can bust through the 100-day moving average, that would be a huge sign. Given the fact that, we had a follow-through day recently, so that would be great. Now, in terms of, relative to other Asian markets, Hong Kong is in an uptrend, Korea is an uptrend, Taiwan as well, and then India followed. So, it's a great setup because, globally, we're entering sort of tail end of tightening by various governments around the world, and we're about to head into reflationary period. So usually it's the emerging markets that come out, out of the gate first. So so this is good to see. Yeah.